Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, February 6th. Sentiment across the European and US equities is somewhat better since yesterday despite underwhelming earnings announcements from big names and a stronger than expected ADP report from the US. In China, well, the trade tensions with the US weigh on investor appetite, but the AI and robot stocks there are doing quite well. And in the FX, the US dollar pairs gains and lets the euro and sterling regain some field. But dovish expectations for the European central banks, so the ECB and the Bank of England, will likely keep the upside potential limited in both currencies. After all, the Bank of England is expected to cut its rates by 25 basis points when it meets today. So as I said, sentiment across Europe and the US was slightly better at yesterday's trading session. Most major indices on both sides of the Atlantic Ocean ended the session in the green, but gains in the US were actually questionable due to the underwhelming set of earnings from big companies including Google and AMD and also Ford, and also a better than expected ADP report that actually showed that the US economy added 183,000 new private jobs in January, which was comfortably more than around 148,000 new private jobs penciled in by analysts, while the S&P services and composite PMI numbers hinted at a faster than expected growth in the US activity in January. Now, happily for the Fed, those, the ISM numbers from the US looked softer than expected by analysts, and along with the US Treasury's announcement that it does not anticipate increasing its auction sizes for nominal coupon and floating rate notes for at least the next several quarters, will send the US 10-year yield 12 basis points lower yesterday. The 2-year yield in the US eased as well. As such, the S&P 500 gained 0.39% with around 350 companies there eking out gains, and Nasdaq 100 extended its own gains despite disappointment in Google. Nvidia jumped 5% yesterday, given that the big technology companies like Meta and Google that made up to 50% of its revenue in the third quarter of last year insisted that they will be spending more on AI this year. And in numbers, collectively, Alphabet, Meta and Microsoft are projected to spend around 228 billion US dollar on capital expenditures in 2025, and that's around 75% more than they spent last year. And obviously, a part of that cash will flow directly into the pockets of Nvidia. Elsewhere, Qualcomm actually topped expectations yesterday after the bell, but the stock price fell nearly 5% in the after-hours trading due to a slight miss in intellectual property licensing revenue and lower than expected licensing revenue guidance. And Amazon is due to report its own holiday season earnings today, after the US closing bell, with all eyes set on its cloud revenue, which is expected to post a nearly 20% growth year over year, which would be the largest growth in 2 years. Now, speaking of technology and AI, well, Chinese AI companies, along with their robot shares, are doing quite well these days thanks to the DeepSeek push. So the CSI's Artificial Intelligence Index rallied 3% yesterday and almost that much today, and is up by more than 13% since January 13, while the CSI Robot Index jumped more than 4% yesterday and is up by almost 6% today and reached the highest level since March 2022, and has obviously potential to attract some more gains, if nothing, on the convergence narrative with the highly valued US peers. After all, if the European stocks are good to buy due to convergence trade, why not the Chinese AI, right? So that brings me to Europe, guys, where the economic picture didn't necessarily change much yesterday after the release of a set of weaker than expected PMI numbers across the Eurozone countries that mostly confirm the gloomy economic outlook in the old continent and obviously reinforce the idea that the European Central Bank should simply do more to support the underlying economies in Europe. Good news though is that France has a budget and also a PM right now, so that's big news. It doesn't really change the reality of unstable politics in France, but it does somehow contribute to narrowing the spread between the German and French sovereign yields, and that's obviously positive for sentiment, at least for the Eurozone and in the short run. As such, the Stoxx 600 index gained yesterday while the euro-dollar rebounded, but note that the rebound that we saw in euro versus the US dollar was more due to a broad-based weakness in the US dollar following a sharp fall in the US sovereign yields rather than the good news from French politics. And you know how it goes, right? If the US dollar leads the way, well, everyone else follows. As such, the euro-dollar tested the 50-day moving average offers to the upside yesterday but couldn't clear them, as cable tested its own 50-day moving average to the upside but attracted top sellers above this level. If the US dollar eases more this week, I don't know, on the back of waning trade tensions and ideally soft US jobs data that would support the Federal Reserve, both the euro and sterling could eventually find some more room to extend their recovery without necessarily damaging their medium-term bearish trend against the US dollar. So on Friday, the US official jobs data should give us a clearer short-term direction for the US dollar. A softer than expected jobs report from the US could lead to a further dollar weakness across the board in the immediate future. As such, the short-term tactical traders in the euro and in sterling could take advantage of a potential temporary relief for the single currency and for sterling against the US dollar. While this is important to note, I think the medium-term traders will still be seeking top selling opportunities to strengthen their bearish medium-term positions. And note that the euro-dollar will remain in the medium-term bearish trend below the 106 major Fibonacci retracement, and cable should remain downbeat below the 1.2650, its own 38.2% Fibonacci retracement level. After all, the Bank of England is expected to lower its interest rates by 25 basis points today, as Rachel Reeves' growth plans are clouded by the country's restricted finances and calls for further BOE support for the economy. In Japan, the Japanese yen got a nice energy boost as BOJ's Tamura said that Japan's neutral rate is at least 1% and added that interest rates in Japan must reach that level by the second half of this fiscal year, when he said the outcome of annual wage negotiations in Japan will likely confirm broad-based pay increases, including for smaller companies. So his hawkish comments strengthen the hawkish Bank of Japan expectations and actually pull the dollar yen to below the 152 level shortly. And provided the way that the things look at the BOJ these days, the way this time is certainly open for a sustainable slide in the dollar yen below the 150 psychological level. Note that the dollar yen will step into the medium-term bearish consolidation zone if it slides below the 151.20 level, which is the major 38.2% Fibonacci retracement on September to January rebound, and it could well go below the 150 level if that Fibonacci level is taken out. Elsewhere, recovery in Aussie and CAD remain particularly vulnerable to Trump trade news. And note that, despite waning tensions, UPS decided yesterday to halt deliveries from mainland China and Hong Kong due to tariff delays. And China pointed its finger at Apple and its App Store as a continuation of the escalation of the trade war between US and China. As such, gold extended gains to a fresh record high, while crude oil tanked more than 2% to below its 100-day moving average after the EIA data in the US showed that the US crude inventories popped almost 9 million barrels last week. So the outlook for crude oil remains negative, and price rallies should actually see resistance within the $73 to $75 per barrel range, including 2 Fibonacci retracements and the 200-day moving average. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.